Hello everyone, welcome to another session on dollar INR. Rupee has been weakening consistently and it has touched the all-time low above 90 and there is widespread nervousness in the market. All of us are aware why is rupee weakening. What is really surprising is rupee is weakening when the dollar index is muted. Dollar index is not really strong but actually relatively weaker. So during an environment of weak dollar, we have a weaker rupee. That is the real catch. That is the real surprise. Okay. So if you look at the chart, it is a continuous dollar uptrend. Okay. We first broke 88, then we broke 89, and now we are above 90. Widespread nervousness that this will go to 91, 92, and the continuous rupee weakening is something which is here to stay. Okay. What is going to happen in the future, that is anyone's guess, but what we can do from our end is try and mitigate the risk by taking some smart hedging strategies. Okay, let me come to something that I wanted to explain. I've been talking very regularly about doing vanilla options to hedge risk. Okay, either using a simple vanilla option or using a structured option. The basic idea is to use a vanilla option to hedge risk, and I want to show you how it has been very effective in the last 6-7 months. Okay, but understand before that what has been the normal dynamic in the market. The normal dynamic in the market is that exporters used to usually hedge using forwards and importers were very reluctant to hedge because they had to pay the forward premium. Okay, but now what has happened is exporters who have hedged, they have lost money because rupee has weakened more than the forward premium they have received, and since rupee has weakened substantially and importers have not hedged, they have also had very negative prices on the rupee weakening. So in such a scenario, what should we do? Okay, here I have created a very simple example which will give you a good amount of understanding of how vanilla options work and how vanilla options would have helped in this time when rupee has weakened. Okay, now let's look at a simple example. Okay, we are standing at today 8th of December. Okay, for example, I would have done a vanilla option, let's take 2 months back. So I would have done an option on 9th of October. So October, November, December, just 2-month option. On 9th of October, the spot was 88.77. If I would have done a simple forward, I would have received a premium of around 30 paise. So my forward rate would have been 89.07. Okay. Now, if I would have done an option at 89.07, that is, this is the strike price, this is the forward rate. If I would have done an option at 89.07, I would have to pay an option premium of 50 paisa. Okay. So 50 paisa is the protection or the cost that I have to pay for a protection for 2 months. Now let's evaluate, if I would have done such an option, what would have resulted that option on the expiry, which is today. Okay. Remember, today the spot is 90.15. Okay. The spot is above 90, so the spot is 90.15. So this is the exporter's case and this is the importer's case. Very simple. So if the spot is at 90.50, remember I have taken a put at the forward rate. So this is the forward rate. So I have taken a put at 89.07 and I have paid a premium of 50 paisa. Now since market has gone to 90 plus, I will not exercise my option. I will just let it expire. Okay. So since I have not exercised the option, I get this market rate, but I have paid this 50 paisa premium. Okay. I get the market rate, but I have paid the 50 paisa premium. So my net rate is 89.65. Remember, if I would have done a forward, I would have got this. Okay. If I would have done a forward, I would have got 89, but since I did an option, I got 89.65. Okay, which is 58 paise better than the forward rate. So here very clearly the option has worked out far favorably than a forward rate. Got it? But again, if you compare it with the market then obviously if you wouldn't have done anything, you would have got 90.15. So from the market I am 50 paisa off, which is the option premium that I have paid. But as I said, where is the market going, that only God knows, it's anyone's guess, no one has any idea. But in this scenario, for an exporter, doing an option would have worked far better than doing a forward. Now let's come to the importer's case. Importer's case is usually the corollary of what the exporter is doing. So simple again, I took a call, dollar call at 89.07. Okay, now since the market has gone substantially higher, it has gone to 90.15, I will exercise my option. Okay, so I will buy dollars at 89.07, and since I have paid this 50 paisa premium, my net cost will be around 89.57. This is still better than the market. Okay, remember, if I wouldn't have hedged, I would have to pay 90.15, but since I hedged and I am able to buy at 89.07 with adjusted cost of 50 paisa, I am getting 89.57. Okay, so from the market I am 58 paisa better. But obviously here in this case, in an importer's case, if I would have simply done a forward, then I would have gained than the option. Okay, so here if rupee is weakening, for a simple importer, a simple structure would be to do a forward. But again, anyone's guess, where is market going. So here we see very clearly that in this rupee weakening time, when exporters are hedging using forwards, that has been counterproductive. You have lost money. Options come in very handy. They help you recover, they help you with profits, they help you in participating when rupee is weakening. But in case of an importer, if rupee is weakening, obviously the forwards will work out better. But here even an option has worked out better, because again no one knows where the market is going, so it is better to remain hedged. So even if an importer who usually doesn't hedge would have hedged using an option, it would have worked out very well. Okay, so that is the bottom line of this video. I wanted to emphasize about doing vanilla options. I've been talking about that for about last 4-5 months. Just imagine if you would have done vanilla options in this kind of a time when rupee is consistently weakening, both the exporter as well as the importer community would have gained. Okay, but the bottom line is, the most optimum hedge strategy is to do some kind of a combination of forwards and vanilla options. Not only vanilla options, because it turns out to be very expensive, and not only forwards, because you can see if the markets go haywire the way it has gone in the last 6 months, only forward hedging strategy will not be effective. Bottom line is, some combination of forwards plus options, that is the ideal forex risk management strategy. So that is it from my side. For more such insights on forex markets, please join our WhatsApp community.